All right, students, this is going to be part A of lab number 3 of the videos. As you remember, we are now going to have our classes on videotape. All right, first of all, I want to let me first welcome everybody back. Hopefully everybody's staying safe. And also, I just want to remind everybody that, we're not going to have, from now on, we're going to have our classes online. A lot of your classes will be, most of your classes, all your classes will be online. But for our class, what we're going to do is, because I know you guys have some flexibility issues, some of you guys have internet issues, I'm going to try to record. I'm failing at this right now, but I'm trying to record the YouTube videos like a few days in advance, load them onto YouTube for our lecture. And then if you have any questions or if you have any errors, then the normal time our class meets, we will have a WebEx section where I will be there and I can answer, and it'll basically be like office hours. So normally when our class would meet, we're now going to have office hours online, and the before the office hours online, I'm hoping I will give you guys a few days to have the lecture already pre-recorded on YouTube like I'm doing right now, and you guys will have time to look through it, work through the code, and if you understand everything, then it's fine. You don't have to log on to WebEx. But if you have any questions or if you have any errors, feel free to log on. All right. And before the break, um, we started lab 3, and so this will be the video for part A. And so this lab will be broken up into part A, which I'm doing right now, part B in a separate video, and part C, which will just be 10 minutes. And then after that will be practice set. There'll be a video for practice set 3. So a lot of videos for you guys to go through, a lot of things for you guys to check out at your own pace, and then we could talk about it on WebEx. All right. So I'm starting off with lecture slide 16 on lab 3 because lecture slide 16 is where we basically talk about quantitative value investing, what we're basically focusing on in this class. We talked about previously in our other class, if you guys remember. If you don't, feel free to look through the slides. How we can't, I gave the example how we can't do with Wolverine and Cyclops and the lemonade stand. We can't do that style of investing, right? One, it takes tremendous amount of fundamental understanding, tremendous amount of industry understanding to do that kind of investing, right? So what do people like us that are mathematically and I don't know if programmatically is actually a word, but we're more technically inclined. How do we do it? Quantitative value investing. What does that mean? Essentially, what quantitative value investing is you take the same ratios that were used in value investing. All right. Remember, even in value investing, they're doing a lot of assumptions, a lot of industry, all this stuff, but everything still gets quantified into ratios. In finance, in any industry, it does not matter. Everything is quantified into ratios. All right. And we're using these ratios and we're trying to build very simple models, or more importantly, screeners, quantitative screeners that basically screens for us, hey, what's a good stock? Hey, what's a good price? Et cetera, et cetera, et cetera. That's essentially what we do. We take tremendous amount of data, program it, crunch it, and apply it to all the stocks and securities and investments we possibly can. Remember, as value investors, they look like Buffett and Munger. They look at probably 10 stocks. That's all they can do, right? That's all they can do. Research analysts, they focus on an industry or maybe some stocks within a certain industry, right? Even if that industry is too big. That's not how we play. We play by basically looking at the whole stocks and looking at different quantitative ratios and different kind of levels to try to say, oh, this is a good stock. We're basically assigning scores, quantitative score numbers, numeric scores to stocks to identify for us what's a good deal, what's not a good deal, et cetera, et cetera, et cetera. That's what quantitative value investing basically is. All right, now, there are 4 essential ratios. Now, in the fundamental world, they have their own grouping for ratios. In the quantitative world, we tend to have our own grouping for ratios. All right? Group 1 tends to be the ratios that are measure the legitimacy of the financial statements, right? And of the managing boards of these companies. What does that mean? Our data comes from the balance sheet, income statement, and cash flow statement, okay? If that data is messed up in the slightest way, if it's adjusted in any way, boom, garbage in, garbage out. No matter how great of a model you have, garbage in, garbage out. Our model, our scores are totally irrelevant and they're wrong. All right. There was a case many years ago called a company called Enron. All right, Enron. They, along with I think Anderson Consulting, right, were that was their auditor. They were cooking the books, right? There's a reason why Enron and Anderson Consulting they don't exist anymore. All right. And what's funny is that and there were some Columbia MBA students that were using a famous model called Prob-M model to basically look at the financial statements of Enron and saying, "Hey guys, look, there's something not right here. There's a high probability that these financial statements are illegitimate or they're being fudged. They're being changed up. They're not right, right?" And they kept saying this. They kept saying this. Eventually, Wall Street caught on, and this is a famous story because each one of these Columbia, it was some first project for class. Each one of these Columbia MBA students got a great job on Wall Street because of their analysis and what they were kept pushing on Wall Street. Great story. So Group 2 ratios are more the fun ratios. Group 2 ratios are basically the ratios that say, hey, this is a wonderful business or a great business. All right, and we'll talk about that a little bit more later when we talk about ROC. And Group 3 ratios are basically the ratios that say, hey, you know what? The price of this stock is a fair value. That is the first ratio we'll look at, earnings yield. The earnings yield is from this Group 3, and that's one we're going to do in this lecture. And Group 4, the Group 4 financial ratio, that is the ratios, and this is the creme de la creme, these Group 4 ratios. These ratios are rare, hard to do, hard to identify. These are the financial ratios that define a competitive advantage of the company, right? And it's funny because on Twitter, I'm not Twitter, on LinkedIn, I was arguing this point, right, about Disney, right? What is a competitive advantage? It's the brand of the company that other companies are trying but can't touch. That other competitors, if they jump into the field, they can't compete with. And I already brought up one point, Disney, all right? Disney has a solid brand, right? Anything tagged with that Disney thing, kids and parents pay attention, all right? Disney World, it sucks. What's the big deal, man? All right? It's rides, whatever, all these characters. But the characters, where it is, the content behind it, that's what makes Disney Disney. Who's gonna touch that? All right? Maybe Nickelodeon. Other than that, Disney has Disney. Disney now, by the way, also has now more Marvel and Star Wars, right? Marvel now has trademarked itself as a brand for great movies, great crossover movies. Star Wars, not so much, but still making money off of it. All right, you got to fire Kathleen Kennedy. Anyway, so another example of a competitive advantage: Coca-Cola. All right, we can all go out and make Wodge Cola. Literally, it's carbonated water, it's sugar, and it's color. That's it. Will anybody buy Wodge Cola? Nah, they're not. Everybody will buy Coca-Cola though, right? That is a fantastic brand. Amazing brand awareness. And and even if you go to the supermarkets, you'll see there's a Stop and Shop cola. There's this, other kind of colas. They're cheaper. Nobody's buying it. Nobody's buying it, right? So that's a Group 4 ratio. That's creme de la creme. In this semester, we're going to look at a one ratio from Group 3 and one ratio from Group 2. Today, we're going to look at our first ratio, which is earnings yield, right? Which is from Group 3, right? We don't, as value investors or quantitative value investors, remember, we aren't technical analysts. We're not what we call technical analysts. The price isn't the information for us, right? As value investors, the price tends to be noise that has a lot of emotion behind it, overreaction. We believe the market always overreacts. It always tends to go up too high, and it always tends to go down too low. All right, it always tends to overreact. To us, the price is just noise. We need another ratio to help us gauge whether the price we're going to buy something is indeed a fair price, and that's where earnings yield comes into play. All right, so here is the formula for earnings yield, and let me break this down here. All right, now I'm sorry, this is not the formula for earnings. This is the formula for the denominator of earnings yield. Okay, the denominator of earnings yield is what we call total enterprise value. Now, what is total enterprise value? Total enterprise value is basically the hypothetical cost or the amount of money you would need to take a public company a public company that's again traded in the public stock market. Apple, Tesla, what else traded? Facebook, whatever, all these companies. So take these public companies and literally buy it out and make it private so that you own it. And there's times this happens. Dell did this, right? The founder of Dell got together with some private equity firms, with some banks, and he took his company that was a public company and he sold it and he bought it back and it's now a private company, right? So this happens from time to time. So that's what total enterprise value is. Now think about this logically. If you're going to buy a public company, what are the components? What would you need to buy of that public company to truly make it your own company, private company? Well, first off, you have to buy every single outstanding share that's publicly traded. Every single one of those shares you got to buy, right? So that's why the first component here is what we call the market value. The market value of the company. It's all the shares that are outstanding that are publicly traded times whatever the current price or the target price you need to pay to those shareholders to buy that company. For the purpose of our analysis, we just take the most recent market price, right? So shares outstanding times market price, that's my market value. And that is the largest component of my total enterprise value. Now, what's the second component here? The second component that we need to add to our total enterprise value is total debt. All right, why total debt? Why the hell am I adding total debt to my total enterprise value? Because when you buy a company, guess what? You buy its property, you buy its patents, you buy its factories, and you take over that debt, right? You take over that debt. I love to tell the story of this casino in Atlantic City. I mean, it's back again, but before it came back, it was called Revel, right? And it went bankrupt, and it was a beautiful casino, and it went bankrupt. And when it went bankrupt, people were bidding to buy it, right? And the person that eventually bought it, you know, they bought it for $1. Okay, how is it possible that such a big, huge, beautiful casino was sold for $1? Well, because he didn't really just pay $1. He paid $1 for the right to buy it, in the sense that first of all, why dollar? Well, a dollar I found this out when I was on the trading desk, the ABS CDO trading desk, when I was a quant on it. But the smallest amount needed for any kind of transaction in the court of law is a dollar. So that's why a dollar. That's number one. But then again, okay, why did he just pay a dollar? He paid a dollar because obviously there was massive debt on it. He didn't obviously just pay $1. He paid $1 officially to take ownership of the casino, but he had to pay a lot, millions and millions more in court, right? So in other words, he had to pay back all the creditors. He had to pay back all the creditors, and there's negotiations that happen. Oh, maybe he'll negotiate. Listen, I'll give you 50 cents on the dollar back on what you borrowed, etc., or what you lent out to this casino, etc., etc. So there's a tremendous amount of money that's being traded when you do that. That he had to pay, because again, when you buy, anytime you buy the business, you buy the debt, and that's why we add total debt to our total enterprise value, the total amount we need to buy out this company. Now, we subtract out cash. Why are we subtracting out cash? Hypothetically, I buy a pizzeria. I spend $100,000 on that pizzeria. Guess what? I also, once I buy the business, I get access to, I get the bank accounts are mine as well. That pizzeria has $50,000 in it. How much did I really pay for that pizzeria joint? $100,000? No, I paid $50,000. 50 of its own thousand goes back into my pocket, right? That's how we subtract cash out. These last two parts, you hardly see this anymore. Preferred shares and minority interest. Preferred shares and minority interest used to happen back in the days when somebody was a founder of the company, or he was a early investor, and they just got these protected securities that they always own a certain percentage of that company. All right, think of Eduardo in Facebook, the network on the movie, some concept like that, right? Most of the time you see these as being zero, because nowadays your private equity firms, your venture capital firms, as these startups, they go into different rounds of funding, they make sure to get rid of these people. So these tend to be zero, but time to time there's companies, legacy companies, that still have these. So these are basically just private investors that have a minority interest of some preferred shares. And we technically obviously have to buy out these guys as well, right? All in, that's our total enterprise value, right? That's basically a total enterprise value. All right, now, a couple of variables over here. We, in our data set, eventually, as you guys are going to see, we don't have total debt. What we do have is we have total debt per share. That's okay. We simply, when you have total debt per share, if you just multiply all the shares outstanding by total debt per share, you will get your total debt. All right. And you'll notice that all these variables have this little sub t in it. Why? Because the total, these items in our data set, they change quarter to quarter. So the question is, what's the total enterprise value? Okay, you were talking about calculating the total enterprise value for which period in time. All right, that's why we have these sub t's things. Because remember, these data points, they change every quarter to quarter. All right. All right, now that was the denominator for earnings yield. So what's the numerator? That's easy. The numerator is just the average operating income going from the current operating income going back 3 periods. All right, that's why again, you see the T over here. So if for, let's say, the first quarter of this year, are we in the first quarter of this year? Let's do the last quarter of last year, 2019, right? If I wanted the total enterprise, if I want to calculate the earnings yield for, let's say, Tesla, as of the fourth quarter of 2019, I'm going to use the total enterprise value of the fourth quarter of 2019, but I need the operating income T for the fourth quarter of last year, the third quarter of last year, the second quarter of last year, and the first quarter of last year. You see, the numerator, we want to take the average of the operating income. Why? Well, because operating income is basically theoretically the amount of money that would go into our pocket after we bought the company. Why do we choose operating income? You have earnings, you have net income, you have all this stuff. Why are we choosing operating income? The key is, if you look at the income statement, right? The income statement, look what we have first there. This is the income statement, guys. You got your total revenue, cost of revenue, gross profit. Nice. You got your operating expenses, right? Again, what's the cost of revenue, right? This is basically your long-term costs. This is what your gross profit. This is from your revenue. This is what your gross profit is. And then you have your operating expenses. This is the expenses you have from your operations day to day, right? You subtract all this bad boy out, and then now you finally get to operating income. You'll notice the operating income is pretty high up there on the income statement. And again, the operating income basically symbolizes what goes in our pocket before taxes, but basically the profit we take before we have to pay taxes and all this other stuff. All right? Now, what's the deal with the ordering of the income statement? We talked about this before. You see, the order of the income statement is basically how verifiable those values are. The higher the value, the more easier it is, not the more easier, the easier it is to verify those numbers. The lower you go, the harder it is to verify, right? The more games, legal or otherwise, okay? These corporate accountants are very sharp. These companies can do to finagle the numbers. We, as quantitative value investors, don't have the expertise to understand how these guys are finagling the numbers. We don't know the context of their company and what they're trying to do. So we try to stay up top on the balance sheet and income statement as possible, right? And that's why we take operating income. It's just the easiest thing for us to do. That's why we don't mess around with net income. Net income is highly adjusted from company to company. Operating income gives us a more equal footing from company to company. All right, so that's what we take operating income. The average operating income over 4 different periods divided by total enterprise value. Ladies and gentlemen, that is earnings yield. That is earnings yield. All right, now let's do an example right here. Let's say I give you this data set right here. Assume that you can either buy bond B, right? Bond B. Now, a bond is basically a loan that you give out to a corporation. So they give you a fixed interest rate. That is giving you a 10% annual interest payment. All right. So hypothetically, let's say you, for example, you bought bond B for $1,000. You get annually $100 back. All right. So that's basically the gist of it. So this bond B gives you 10% annually interest payment. All right, not bad. Or you can buy the stock A, which is down here. Now, both the bond and the stock are of similar risk and credit quality. What does that mean? That means that in terms of uncertainty of your cash flow, uncertainty of the underlying business, they're the same. It's the same. Okay? There's one investment is not more riskier than the other. They're both the same risk. All right? Now, if that's the case, what would the price of stock A need to be for it to be considered a fair price? Below are the fundamentals of stock A. What are we basically setting up here? Here we're setting up a situation where stock B, bond B, and contextually gives you a pretty fairly certain payout of 10% a year, right? This is serving as my benchmark, right? That is basically, that 10% is basically the yield I'm getting from that bond, the actual yield, if you want to think about it, all right? Where are we headed here? So if that's the case, what is stock A's yield, right? What is stock A's yield? And remember from the previous slide, right? In my denominator, that's where the price is. If the price is in the denominator, that means the stock price inversely affects my earnings yield. Inversely, what does that mean? That means as the stock price goes down, my earnings yield number goes up. As my price goes up, my earnings yield goes down. In this situation, I have somewhat of a benchmark. I have this other investment called bond B that is the same in terms of risk-wise as stock A, and I'm pretty much certain that I'm going to get a nice 10% payout every year. I'm going to have a yield, or earnings yield, of 10% from that bond. If that's the case, then what should the price of stock A need to be for it to be considered a fair price? Ladies and gentlemen, bond B, that earnings yield 10% is our benchmark. Whatever price is the fair stock price for stock A is going to give me an earnings yield that is 10%. That's the point I'm getting at. That the fair price here will be a price so that the earnings yield will be a number that will be equivalent to your benchmark yield or your benchmark earnings yield. And in this case, I have a bond sitting there pretty that it can give me 10%. Therefore, my benchmark for my earnings yield is 10%. And if my benchmark for my earnings yield is 10%, then I need to back out the price that will give me that 10% earnings yield given the data here, given the fundamental data here. Let's do this, right? Let's do this. And now you guys can see earnings yield in action, how this works. So my numerator is the average of the previous quarters of the current and previous quarters of operating income. My denominator is my total enterprise value, all right? To answer this question, I need to solve for price. Here's the equation. I'm going to apply algebra here now. I'm not algebra. Yeah, I'm going to play algebra here. Sorry, I'm losing my mind. I need to apply algebra here now, guys. What do I want to do? I want to take the denominator here, all right? The denominator here in the first line, I can't seem to highlight it, right? And I want to, here, I'll highlight this. I want to replace this earnings yield over here, which is not going to be my benchmark earnings yield. Remember, this has to be 10%. I'm going to swap this with the denominator down here on the right side. And that's what happens in this line right here. Notice earnings yield, my benchmark earnings yield is down here. Again, that should be 10%. And whatever was before that in the denominator is now up here, right? Why is that? Because we're trying to isolate price, guys. Remember, we're trying to isolate price. We're trying to solve this equation in terms of price. All right, now, this value, subtract over here onto this side. This one, I add on to here. This one, subtract out to here. This one, I subtract out to here. Excellent. Now I'm just left with shares outstanding times price equals this mess of an equation right here. All that's left is to divide out shares outstanding. I divide shares outstanding, and now my price equation, by rearranging the formula for earnings yield, becomes this right here. Becomes this right here. All I have to do now is just plug in the numbers. All right, so here's my equation. Here's my original data. Let me plug it in. I think I have a typo here, by the way. So, yes, I have a typo here. So the average of the operating income is actually 110. This says 11 here. This should be actually 110, guys. So in slide 22, the numerator should be 110. All right? Over here, what is that going to be? Again, that is my benchmark earnings yield. That is 10%. We get that from the bond. Boom, I put that. So this is 110 divided by 0.1 minus total debt. What is total debt? Well, total debt, again, I said before, is total debt per share times shares outstanding. That's the total debt. We add cash. What's cash? 4. We subtract out preferred shares, minority interest. Well, those both are 0. Boom, boom. And I divide all of this by shares outstanding, which is 24. You calculate all of this, again, this part right here, that should be 110 divided by 0.1. The price will be $26. $26. All right? What does that mean? That means my price, that is the fair price. Now, first of all, I'm cheating here a little bit because these are quarterly numbers, and that 10% yield is on a bond that's annual. Ignore that for now. On the practice set, we'll do it quarter by quarter, but for here, I just want to keep it clean. I just want to keep it simple. So for this one, just suspend the fact that this is quarterly. These are quarterly operating incomes. Assume for a second that these are annual instead of this is annual numbers instead of quarterly numbers. All right. And so we get this price $26. That is my fair price. That means stock A cannot be greater than $26 for the yield to be. If stock A is at $26, the earnings yield will be the same as my actual yield for the bond. Now, if the price goes above $26, that earnings yield is going to go down. It's not a fair price for me. If that stock goes below $26, that earnings yield goes above that 10% yield of the bond. Hey, that's a better deal. That's a fairer price for me, right? That's a better price for me. I'll buy it. That $26 now, that's our little benchmark. That's our number, right? That's our number. And that's how we use earnings yield to basically back out these values. Now, for this part, you could skip slide 24 and 25 because we're calculating using R, using data frames, but we don't do that anymore. We don't use data frames for R, right? We use data tables. Data frames are the native table abstraction in R. I mean, they're there, they're fine, but in companies, in corporations, we actually tend to use data tables. Anytime in work you're going to use R, you're going to use data table. All right, that's the way it works. All right, so now we want to basically now go ahead and do our actual lab. For our actual lab, I have these two data items. Go into Blackboard and show you. All right, here you guys are. And as you can see, I posted. Oh, I didn't post it. Let me post it live. We'll do it live. Oh my god, I didn't post your data sets. Let me post those data sets for you guys. Uh-huh. Right. Data RDS. Excellent, so that's there, and now I'm going to load up the other price DF RDS. Now, what the heck are these RDS things? These RDS extensions basically are the, let me do this for you and I'll explain it. So just like in our R script file, a .r extension means that it's an R script file, it's an R program. In R, the .rds extension basically means that this is a data container that we saved onto your machine, right? That's what it is. It's a data container that we saved onto your machine. So vectors, tables, anything, all that data, when you mess around with it and you work on it, you fix it, you clean it, you can save it and then call it back into R to work on it because it takes time and effort. You don't want to keep running the R script to change it, especially when you have massive amount of data. All right. So here are these two files. All right. I'm going to go ahead and start the lab number 3, where we calculate using these files. Data.rds has our fundamental data. Price.rds, I cheated here for you guys, and I used QuantMod to get you some historical prices for these tickers. And the historical prices I got for only 3 dates: September 1st, 2015, September 1st, 2016, and September 1st, 2017. Why did I choose those dates? Well, because I chose the dates because, again, we want to run. I want you guys now to use earnings yield to basically pick stocks, which is kind of a bad idea, but we're going to do it anyway. To you know, make some sort of simple selection model to pick stocks, and we're doing it for these dates because I'm trying to mimic our Lab 1 and Lab 2, where we were buying stocks on the beginning of September of 2015, 2016, 2017. This time we're only going to do it for 3 periods because, unfortunately, my fundamental data only goes up to 2017. I'm working on a source to get I'm working on to get more up-to-date data, but for now we only have it up to 2017, right? And data RDS is quarter end data, right? So that's why we're going to use, in terms of data RDS, we're going to use, and this part gets a little confusing. We're only going to use these data points in time. If you look at the data RDS once we load it up, you'll see that the date format is like this, and we're only going to use these 3 data points. Now, I'm calculating the earnings yield. Here's the confusion for you guys. I'm calculating the earnings yield as of these dates right here, right? Why am I simply going to take these dates from the fundamental data then, as of June? Why am I not taking '09? The reason being is because I am going to trade as of the beginning of September. Therefore, I'm going to look at the earnings yield score as the beginning of September. Therefore, I'm going to use whatever data is available to me from the balance sheet, income statements, and cash flow statements as of the beginning of September for these 3 years. These fundamental balance sheet, income statement, cash flow statements are always published at the end of the quarter. So 2015-06 means the end of June, June 30th. If I were to grab 2015-09, for example, that would be 2015-09 end of September, September 30th, right? Here we have a logical conundrum. You cannot use, if I'm calculating the earnings yield at the beginning of a month, September, I can't use data that has yet to be published as of the beginning of the month. The 2015-09 fundamental data won't be published till the end of the month. You cannot cheat and go forward in time by 30 days and use those numbers. You have to use the numbers when you're calculating earnings yield as of this point in time for whatever data is available at that point in time. And that is why, from data RDS, for these 3 periods in time we're calculating the earnings yield, we are using these dates for our fundamental data. All right, these dates are our fundamental data. Now, I have a basic outline here. Let's go ahead and just jump into it. All right. Now, first of all, I obviously have the data on my machine. I need you guys to go ahead and download data RDS and pricedf.rds. I need you to download it, put it into your class folder. All right, assuming you guys did that right. All right. Now here I show you a harder way to basically load it up. This is basically you setting working directory and then running these commands. Right? This is basically when you do session set working directory, choose directory, you're choosing the directory where you just loaded those files in. Okay? We pretty much just loaded those files in. Now, and then you go ahead and run line 25 and 26 right here, or these 2 lines. Now, there's an easier way to do this without changing the working directory and running these 2 lines, and I'll show you that right now. Right? First of all, let me open up my own R script file, and let me save this R script file as and I'll call this lab 3 Newark. Alrighty. Now here, I have the script file. I want to load in my data. So how do I load in data.rds and pricedf.rds? Very easy, guys. Go to File. Go to Open File right here. Do you see it? And now just go grab your file, wherever it is. So mine is here here? Spring 2019. There's data.rds. I grab it, this window pops up. All right. What does this mean here in this window? This basically is like, all right, look, I'm grabbing that table. Do you want to keep it named as this table in your R? Yeah, that's fine. And you'll notice, boom, this pops up. This is a table, data frame table for now. You see this little box right here? You click on that, boom. Ah, you got all your table, your data right here. It looks like an Excel sheet. Look at that. Fantastic, huh? Fantastic. All right, so let's go ahead and grab our other one, our price DF table. Same thing, go up here, file, open file, price df.rds, click on it, and again, it's asking me if I want to name it that, and I'm fine. I'll name it that. Boom. Same thing here. See the little box right there? When my mouse is over it, click on that. Boom. And you see what prices I have. I have these ticker prices, all these different tickers, and I have these 3 points in time and their prices. All right, fantastic. All right, from here, okay, we can go ahead and run, if I run class, the class function again on data, what does it say down here in my console? It says data frame. It's a data frame. All right. All right, so it's a data frame, meaning that this is a simple table. Now, if you remember, let me do library. When we did quantmod, and let me do get symbols, Tesla, which is giving me so much headache right now in the market. All right, Tesla, I got my Tesla table comes up, my XTS table. If I run class on that, if you remember, it's something totally different. It's called an XTS zoo, whatever that nonsense. It's a table, but it's an XTS table, something completely different. You have to know which table you're dealing with, because the analysis will change. Right now, for us, we use something called data tables. All right. Now, before we go ahead and grab data tables, I want to go ahead and take a subset of that table, and I want to change the name of that table. All right. So I want to select some of the columns. I want to select only the columns I need, because this table is unwieldy, guys. It has 276,000 rows, fine, but it has 25 columns. I don't need all those columns. And again, if you click on, I'm going to show you a little trick here. If you do names, and it's a function, and put data in there, this will give you the name of all the columns. There's a lot of columns here, and look at the names. First of all, you never proper when you're dealing with tables, you don't want to have spaces in your names. That's number one. These names have uppercase, lowercase, spaces. This is a nightmare. So first thing I want to do is I want to basically choose take a subset, if you will, of all the rows of the table. Notice the comma there. To the left of the comma, I'm selecting the rows. To the right of the comma, I'm selecting columns, right? So this is blank, so basically I want all the rows. And I want to basically select, notice I'm using the C function here because I'm selecting more than one column. And I want to basically select a subset of these columns. Now, first of all, what do I want? I want the date column. Now, I'm doing it like this so that I don't make it, for those of you who follow along at home, I do it like this, copy and paste, so I make no mistake typing. Those of you guys typing by hand, you will make a mistake and you will have an error. And you're going to be sitting there like, where's my error? This is why I do copy and paste. So I want the date, obviously. There's a column here called prime. What the hell is that? That's the tickers. I don't know why it's called prime, but I'm going to go ahead and grab that. That's prime. All right. Some of the other stuff might make a little more sense. Now, what else do we need? If you remember, shares outstanding. All right, I go here. I'll take this shares outstanding. This is basically means shares outstanding end of period. Copy this. Boom. You can copy the quotes and all. What else do I need? I need cash and cash equivalents. That's my cash. Where are you? There we are. All right, what else do I need? I need operating income. Of course, I need operating income. That's my numerator, my earnings yield. All right, this is going to get a little real over here. I'm gonna just do comma enter just so you can see it, and I'll bring it back to the other line. I need total debt per share. Ah, yes. Total debt per share right here. I need preferred stock. And I need minority interest. And ladies and gentlemen, I am done. Right? I can go ahead and bring this back. Execute this. Notice there's a DF table right up there, guys. I'm going to click on this. Look what we have. All right, look what we have. Alrighty. So I have just these columns. Now, this is great. Much more manageable. But you know what? Again, the column names are horrendous. This is where we're going to change the name of the columns. And I'm going to use this names trick to do it. Names df equals, and now here, I need to use the C function and change every name of the whole column. I got to do it for all of them. Unfortunately, I can't just do it for one or the other. So if I do names down here, df, I see the names of the columns. Let me go and change it. So date is fine. I'll do date. All right, notice now I'm making it lowercase. Why would I have a column name that's uppercase if I don't need it to be uppercase? Why am I giving myself that headache? All right, prime. I will make this ticker because that's what it is. Shares outstanding, SO. Cash and cash equivalents, your cash. Operating income, OI. Total debt per share, TDS. Preferred stock, PS. Minority interest, MI. I go ahead, run this, guys. Hit that box in DF. Oh my God, isn't that so much nicer and easier? All right, we're almost there, guys. Look, I got all the values I need except for two. I need the average of operating income, right? Not operating income. I need the average. Sorry, going back. So I need the average operating income. I mean, I have the operating income for each period, but I need the previous 3 periods of operating income to do the average. All right, how am I going to do that? Well, all right, also, notice I'm also missing one more column here. All right, anybody want to guess what that is? Boom, price. The price isn't there. I need that as well. So those are 2 things I basically need to do. All right, how am I going to go about doing that? Well, this is where I take the opportunity to show you guys. We're going to install data table, and I'm going to show you guys how to use it. All right. Alrighty. So data table. Now, data table is a third-party package. Okay, it's a third-party package, just like before when we installed QuantMod. We have to do a one-time install. We have to do it for data table. All right. Now, I'm a little nervous doing this when you guys aren't here, but just like before, packages, install, boom. Let's go ahead and get the data table. I'll do it right here. I'll do it live. Do it live. All right. Down here, bottom right, again, bottom right window, go to the middle tab, which is packages, click on the install. You're going to type in data.table, all right, and do install. Now, oh boy. I'm going to go ahead and press cancel because I don't want to restart R right now because I'm in the middle of showing you guys. You guys go ahead and install and restart your R. Now, my Mac people, you should be okay, your Macs. My PCs, it might ask you to do a hard install or a soft install. Choose the soft install. Do the simple one. It's fine. It'll work out. All right? Once you install it, you'll know that it worked. If you do, you're going to see a lot of weird things come up down here in your console. If it installed, right, you'll know it worked because you're going to see when you do library, call the sucker in, it'll pop in, boom. You'll get no error. If it didn't install, you'll get an error, right? Same way as before, very easy. All right, so from here, we have my data table, excellent. Now, the first thing I want to do is Again, data table, excellent. The first thing I want to do is I want to convert my data table, my existing DF table, into a data table. How do I do that? Very easy. The command is set DT. So easy. Put that in there, boom, that's it. DF is now a data table. We'll use the class function again to confirm this. Boom. Look down here in my console, people. Do you see it? Data table, data frame. This is now a data table. You're ready to rock. Now, before I unleash everything on you, I think this is a great time to show you how the filtering data, I basically show you the basics of data table, if you will. All right, now, you have all these filtering capabilities in data table. What do I mean by filtering capabilities? You know how in Excel, you have a table of data, and you can filter that table of data by a column or more than one column based on certain values in those columns. That's filtering. That happens in the rows section. You see, data table has up to three sections. If there's no comma, we're simply just putting filters on the rows, just like we do filters on the tables in Excel. If we have one comma, that means we are putting filters on the rows, or possibly no filters on any rows. You'll see an example of that. And I'm doing something with the column. Either I'm selecting some columns, or I'm transforming some columns, or applying some sort of function to some of the columns. And if I have two commas, and I'm engaging three sections, and here's the creme de la creme, people, row, column, and grouping section. What do we mean by grouping section? It's for those of you that, again, took MIS, and you guys all should have taken MIS, the group by, or the aggregation that you can do. Or for any of you guys that have worked with pivot table, with pivot tables you can do certain aggregations. Same concept. All right, same concept. So let's do an example. Let's say I want all the rows from Apple. All right. Bracket, again, just like with my vectors, bracket, I want to select something. And here I want all the columns. I'm not doing any grouping, so I don't need any commas. I'm just filtering rows. Where ticker equals Apple. Boom. You see the results here. Let me scroll up a little bit. Now the results, this is a data table. And notice how the output of data table comes. It gives you the first 5 rows and the last 5 rows. And that 3 little dots right here, that signifies all the data in between that it doesn't show you. Why doesn't it show it to you? It doesn't show it to you because it makes no sense to show it to you in the console. What are you going to do with 120 numbers coming at you? What possible analysis will you make? Remember, R stays true to the heart of data science. And in data science, we always summarize, or we always visualize lots amount of numbers. We don't, or we use ratios to some degree, like we're doing now with earnings yield. You don't just look at 120 rows of numbers. That doesn't do anything for you, right? So let's say now I wanted to filter the data for not just Apple, but Apple and Facebook. Now look, here I say Apple and Facebook, all right? Okay, cool. Then why am I using the OR statement here instead of the and percent? Instead of the and percent, which means and, from a logic point of view. Why am I using that single pipe that says OR, okay? It is because logically, this is a logic issue. In the column, the ticker column, let's go and click on it, all right? In the ticker column, as you see, there's only one ticker value there at a time. There's never 2 tickers there at once. So, therefore, if I want to get a subtable of just 2 tickers, let's say Apple and Facebook, logically, it has to be written like this. Give me all the rows in the DF table where the value in ticker equals Apple, or the value in ticker equals Facebook. All right, and now you can see I have more data. The first 5 were Apple, the second set were, the last part were Facebook. All right, filtering up the rows. Now, I can show you another way to go ahead and filter that data without using that logic. All right, and that's using the and percent in percent keyword or feature. This thing is really cool. See, this is hypothetically, let's say I wanted to filter for 50 tickers. I would to write ticker equals Apple, or ticker equals Facebook, or ticker equals Google, or ticker equals Berkshire, or ticker equals Tesla, and so on, and so on, and so on. All right? But there's a simpler way to do this, using the percent in percent. All right? How do I use it? Boom. It's that simple. What this is doing is, it's saying, give me all the rows. Give me all the rows where the value in ticker is going to be either Apple or Facebook. And by the way, as I have more tickers, I can just add in more tickers right here, right? Another cool thing about this is you can make the vector beforehand. All right, process that, and just use and I could just use a vector, predefined vector, to do the search as well. Boom. All right, nice and clean. Keeps the code nice, concise, and clean, and it's so much easier, which I like. All right, now, I'm sorry. In the slide, there's a typo. I have C's in here. It should be like ticker instead. Now, let's say that's on one column, but let's say I want to filter 2 columns. All right. Let's say I want to filter for Apple. Okay, and I only want the date for 2001. I actually don't have 2001 data in my. I have quarter end data, so this is a typo as well. Let's say 2017-01. Let's go all the way to 2017-01. Let's say I want all the data for Apple, but just for the date 2017-01. Now I need an AND statement, right? Why? Because I have a filter on one column and I have a filter on the other column. Okay? That's why I need the and over there. Because anytime, the more filters you have on columns, each one of those filters on those individual columns are separated by the and. All right, so let's go ahead and do that. Oh, cheat. Grab that right there. All right, just add the and we said date. By the way, in my code, my date's going to be lowercase because in my slides, I left my data as capital D. So you'll have a little discrepancy there. Be consistent with whatever you named your columns. Right? Case does matter. Case does matter. Date equals. Boom. And of course, I just get one row back because I just have one row where it's Apple and date. Once you have a date, the unique combination of date and ticker gives you each unique row. All right. We have tons of dates, we have tons of tickers, but the combination of one particular ticker and one particular date, that's what's unique about each row in our data set. Of course, it's financial data, right? It's financial data. All right, now, what if, here I say not equals Apple and date, but let's make this more manageable for us to see. Let's say I want all of Apple, right? But I want all the dates except for 2017-01. I'm sorry, 2017-03. I want all the dates, I want all the apples except for 2017-03. How do I do that? That's where we use this not, this exclamation point. This means not equals. So when you put that before an equals, it means not equals. All right, so if I want all of Apple except for this one date, place that first equals with an exclamation point, and now it's going to give me, right? It's going to give me every date except for 2017-03. And we know this because, look, down here, it goes from 2016-12, skips 2017-03, goes straight to 2017-06, and then 09 and 12. Again, this is quarter ending data. This is quarterly data. All right? All right. Now, I can take this data, because this is all, remember, this is data tables. I can take it and I can store it in another data table. I'll call this DD. Run it and pop up. Look what pops up right here in my top right window. All right? Click on that. And now you have all of Apple, all the rows, except for what? Except for 2017-03. That easy and versatile, right? That easy and that versatile. And the great thing about data table is, yes, it has all these features and it's much more flexible and powerful. It's made for large sets of data. Data table, Pandas ripped off data frames from R in Python. Well, data table, I made it better. Data table ripped off Pandas for R. And in some R, I've seen some quants argue that in some cases data table is faster than Pandas. All right, that's what's really cool about it. All right, so that was the rows. So we got up to the rows, and now we'll end this video at this point. Right, we'll end this video at this point, A, and then we'll pick up from slide 38 in Lab 3B video and finish it off with the Lab 3C video. And then we'll have all the Lab 3 finishes. All right? Okay, so we'll continue this slide 38 in Lab 3B.